Good morning, everyone. This is Washington Arbitration Week, second edition. And my name is Jose Antonio Rivas. I'm co-founder of Washington Arbitration Week, together with Ian Laird. I am a partner at Strategy LLP, based in Washington, DC, also with offices in Bogotá, in Colombia. And Strategy basically does investor-state arbitration, international arbitration, and public international law. I have the great pleasure of introducing the moderator, Kristen Bauer, who has been working immensely in putting together this incredible panel. And when I say incredible panel, I emphasize that this was an idea that was sort of created between Kristen and myself many, many months ago when Kristen was part of Strategy doing her externship here. And we were thinking about novel topics concerning both economics and international arbitration. And it was born as an idea. It has proven very difficult to put together, but now we're launching it. And one of the reasons why it was difficult to put it together is because cryptocurrency and international arbitration, or cryptocurrency and investor-state arbitration, are topics that go through so many disciplines. You can see here that and I won't steal Kristen's thunder. It's for her to introduce our esteemed panel. But here we have investor-state arbitration specialists. We have lawyers that know more about cryptocurrency and digital assets. We have a former central banker and vice minister of economics or treasury. We have individuals that are at the top of their game in what they are, but it is one of those fields where I think that nobody would know it all. So the depth and breadth of this panel is really incredible. And with that, I'll silence myself, and I will only say that Kristen Bauer is now a legal advisor at the U.S. Department of Commerce. And she has experience working with governments, private sector, and international organizations on a range of international trade, investment, and digital economy issues. And that's sort of the strict line. I should say more than that. Kristen has been an incredible force behind WOW, but also she has the type of mind that this panel requires. She's one of the more creative minds that I can think. She's always thinking in different layers, and she's absolutely the person to moderate this panel because of what she knows. In addition to that, she has a worldview, living worldview of things, and I won't embarrass Kristen anymore, and I'll stay quiet for her to begin the panel. Kristen, it's all yours.
Well, thank you so much, Jose Antonio, for those kind words and for that kind introduction. I thank you so much for the invitation to join this wonderful panel as part of Washington Arbitration Week, and thanks to you and Ian and the whole WOW organizing team for your support and bringing this really interesting conversation and making this event possible. I just really appreciate that. Good morning and welcome to everybody who's online with us today. Welcome. Again, I'm Kristen Bauer, and I am really, really delighted and honored to be moderating this session today. As Jose Antonio said, this is a very cutting edge session. We are tackling, investment treaty arbitration in the digital era and focusing today around the potential for bilateral investment treaties to protect cryptocurrency investments, which in and of itself is a mouthful. And echoing what Jose Antonio said about this being, cutting edge, it feels like every time I open the Financial Times, there is a new development in this space. And so I think it's safe to say at this stage that crypto is more than just a fad. I think it's safe to say that it's here to stay. We've seen crypto adoption soar and investors pour billions of dollars into the crypto market. And at the same time, governments and regulators, in capitals just like this one here in Washington, D.C., are trying to, get a sense of the very nature of these assets and whether and how they should regulate them. And then, of course, this rise of the crypto industry and state actions raises many questions about the potential implication for investment treaty claims, which is what brings us all here today. And these are lots of big issues for us to unpack. But thankfully, as Jose Antonio said, we have a wonderful panel of experts here with us today to help make sense of these issues and help us understand the potential impact of crypto on the investment arbitration space. So here with us today, we have Sophie Naper, who is an arbitrator. She's based in London. She is truly a thought leader in this space on the impact of technology in arbitration. She is also the co-founder of ArbTech, which is a worldwide online community and forum that fosters this sort of multidisciplinary dialogue on technology and dispute resolution. So welcome, Sophie. We also have with us Ana Fernanda Mayahuasca, who is an economist. She is head of the Private Council of Competitiveness in Colombia and a former central banker in Colombia. We're delighted to have her rich perspective on these issues and welcome, Ana Fernanda. We also have with us Tom Walsh, who is special counsel in Freshfield's international arbitration practice in New York. Tom has worked as counsel in numerous international, commercial, and investor state arbitrations. So we welcome his expertise as a practitioner in this area. We also have with us David Atanasio, who is an associate at Decker here in DC. He focuses on international arbitration, and David also recently co-authored a book on international investment protection and the global banking and finance industry. So very topical for us today. Welcome, David. And last, but certainly not least, we have Santiago Rodriguez, who is an associate at Uria Menendez in Madrid, where he specializes in international arbitration and investor state disputes. He is both a US and Venezuelan lawyer, and he has written extensively about the crypto industry, including the adoption of cryptocurrencies in Latin America. So we are delighted to have you with us. So welcome to, and thank you again to this truly expert panel here with us today to help us wade through this discussion. So welcome, everyone. And thank you for being here. So just some quick housekeeping issues about this session. Of course, normal caveats about my personal views, which is that my views are my own and do not reflect the views of the Department of Commerce or of the US government. The format of the session is going to be kind of Q&A. So for all of our participants, we welcome your questions. You are welcome to put those in the chat box. I'm going to be monitoring that and incorporating your questions into the discussion as well. So don't feel like you need to keep those questions for the end. So there will also be a short breakout networking session at the end of the panel. So please stay tuned to all of the participants, and you can join in breakout session with our esteemed panelists and ask them more informal questions if you like. So with all of that, without further ado, I want us to just dive straight in because we have lots to tackle today. So Santiago, I want to turn to you first, and I want you to help us sort of define some of the key issues and terms here at the outset. In this crypto space, as we've already discussed, there's a lot of sort of terms thrown around. This is a developing area. We often hear the terms sort of crypto asset, digital asset, cryptocurrency may be used interchangeably. So I'm wondering if you could help us just sort of break down some of these key terms and issues and help us understand the key differences between them. So over to you, Santiago.
Thank you, Kristen, and thank you, Jose Antonio, and all the WOW team for the invitation to speak here today. So I'll dive right in. I think this is a great question to initiate the debate because whether cryptocurrencies are protected investments for ISDS purposes is really a loaded question because cryptocurrencies really encompass many different types of assets. So asking whether cryptocurrencies are protected investments for ISDS purposes is like asking if art is a protected investment for ISDS purposes. What exactly is art? Do we only include paintings? Do we include sculptures? Do we include taping a banana to a wall as modern art? Who are protected investors? Are museums the only qualified investors? Are the donors of the museums? Are private collectors? So you can see this is like a sort of the same issue applies to cryptocurrencies. There are different cryptocurrencies with different uses and different customers or holders of cryptocurrencies that have different protected rights. So I'm going to answer this question by dividing my answer in three. First, I'm going to answer what is a crypto asset. Second, explain the different types of crypto assets. And third, I'm going to go into how crypto assets are created because I think this is also relevant to the protected investment issue. And I apologize beforehand if my answer is a little long, but I think that we do need to pin down at least a common language to address the questions regarding ISDS. So crypto assets are either digital or digitized assets that exist within a blockchain. Okay, so digital assets are assets that exist only in the digital world. So think of Bitcoin, for example, which it has no physical representation in our physical world. Digitized assets are assets that exist in the physical world, but have been incorporated into the digital world for example, for liquidity purposes. Okay, and a blockchain is a very technical issue that I'm not going to enter into all the details here, but essentially it's a way to store information without using intermediaries. Okay, it's a decentralized way of storing information. Okay, so once we understand what crypto assets are, we can enter into what the different types of crypto assets are. And this is also a loaded term because there is no universal acceptance as to what are the different types of crypto assets. So for example, the US has issued different regulations addressing certain concepts of crypto assets that have not been recognized in other jurisdictions. Switzerland has issued similar guidances that addresses certain types of crypto assets, but leaves other asides that have been recognized in other jurisdictions. So as this is a currently evolving issue, we do need to find some common ground, but understand that this is not like a definitive list. So in general terms, we can say that there are 4 different types of crypto assets, which are payment tokens, utility tokens, asset tokens, and NFTs. So payment tokens are considered digital money. These are tokens, these are digital assets that are used to either transact or as a store of value. So I can give 3 examples of payment tokens, which are in different sides of the spectrum. First, we have Bitcoin, then we can talk about stable coins, and then we can talk about central bank digital currencies. So Bitcoin is crypto, it's a payment token, digital money that is decentralized. It means that nobody controls the Bitcoin network, nobody controls the supply of Bitcoin or the value of Bitcoin. The supply of Bitcoin is predetermined in the Bitcoin algorithm. And so it's not as, for example, like fiat money that's, or central bank digital currencies, as I will explain in a minute, that some central authority can decide to issue more Bitcoin at any given point. And the value of Bitcoin is determined by supply and demand, by the market. And so that's why the price of Bitcoin is so volatile. So as a response to Bitcoin, we have stable coins, which have that technology that Bitcoin has that allows for frictionless transactions. However, the price of a stable coin is pegged to some other coin, some other, for example, $1, that is not as volatile. So The perfect example of a stable coin is Tether, which is the biggest stable coin there is. And one Tether equals $1. And so in this way, you can obtain the benefits of the technology of Bitcoin to make transactions, but reduce the risk of volatility in the price. And finally, on the end of the spectrum, we have central bank digital currencies, which are not decentralized currencies. They are very much centralized currencies. And these would be the equivalent to digital cash. Governments issue central bank digital currencies. They control the supply, and the value of central bank digital currencies will be determined in one of two ways. So again, this is all speculative at this point because there's no official central bank digital currencies, but using statements that governments have made and the IMF as well, we can understand that there are going to be basically two types of central bank digital currencies. So first would be digital currencies, central bank digital currencies that are issued by strong economies. Let's use, for example, the United States. So if the US would issue a CBDC, a central bank digital currency, it would peg it to its own dollar because the dollar has enough market value that you don't need to back up the CBDC with anything else. But let's say, for example, Venezuela, which has a devalued currency and hyperinflation. If Venezuela uses a CBDC, if foreign investors would not feel trustworthy of purchasing these CBDCs to transact within the country because it's a hyperinflated currency. So what these countries with weak economies will likely do is peg their CBDC to an asset they hold, which does invite market trust. Let's say, for example, to gold reserves that the country holds, or a basket of mineral that the country holds. So a CBDC could be pegged to some asset that country holds, and then be converted in case the holder of the CBDC wants to convert it for that asset. Okay, so that is the first type of digital asset, which is a payment token. Then we have utility tokens. Utility tokens are digital assets that enable the use of other digital assets. And the most common example would be Ethereum, that I'm sure that many of you have heard of, the term Ethereum. So think of Ethereum as the App Store in your iPhone or as the Google Store in your Android. Ethereum is an app store, and if you want to purchase within the app store, for example, in your iPhone, you need to use your credit card. And if you buy a game and you want to use the game, and within the game, you want to make other purchases, you use your credit card. Well, in Ethereum, that happens, that you can download and use and buy things in the Ethereum platform. But in order to do so, you need to use the Ethereum coin, which is Ether. Now, the third type of crypto asset of digital asset is the asset token. So asset tokens are the example of a digitized asset. Asset tokens refer to physical assets that exist in our physical world, but have been transformed into the digital world. And this is usually done for liquidity purposes. So think of, for example, mortgage. That it is it can be very complicated to transfer mortgages in our physical world. We need to involve banks, notary publics, registries, etc. By using blockchain technology, this could be done all peer-to-peer between the people directly. So it provides liquidity to certain physical assets that are illiquid in our current market. And finally, we have NFTs, which are very weird and sort of new digital asset that involve characteristics of several other digital assets. And in some, NFTs could be defined as property rights within a blockchain application. Think of, for example, digital arts is the most common example. If you purchase what's considered digital art on a blockchain, it could be considered an NFT. So just by looking at this classification of different assets, digital assets, you can see how, if you understand something about investment arbitration, it's clear that not all of them could be able to qualify as protected investments. I'm not going to get ahead of myself, and I'm going to leave that to other panelists. But the last thing that I want to touch upon is my third point, which I also think is relevant for the discussion, which is the process of how crypto assets are created and stored and transacted, which is through mining. So mining is essentially when a network of computers is interconnected running the same software, which keeps a record of all the transactions in the blockchain. So the novel part of this technology is that if one of the computers in the networks gets damaged or gets interfered with, the record is intact in the rest of the network. So what's relevant about mining, and I think it's relevant for investor-state disputes, is that mining is usually done in what's called mining farms. So it is common to, for example, buy a warehouse and fill it with computers with the network, with computers that are connected to the network, which can be worth millions of dollars. And so this can show how, for ISDS purposes, not only will cryptocurrencies may be considered protected investments, but crypto-related issues such as mining could potentially also become protected investments under ISDS. So thank you very much.
Thank you, Santiago, for those very comprehensive comments. And I think we really have a sense that of the breadth of issues in the crypto space, and that this industry is not a monolith, and that indeed, as you raised, not all of these assets will be relevant in a conversation about investment arbitration. So that's really important. And I'm going to come back to you on the CBDCs when we talk about claims a little bit later, because this issue of sort of central bank currencies, and we've seen some Latin American states already adopt cryptocurrencies in different contexts. And so I want to come back to you on this issue of the CBDCs. But next I want to go to Sophie and kind of build on what Santiago was saying about this diverse sort of range of activity that we see in the crypto industry. I mean, what kind of activities do you see, or I should say, which of these activities do you see are as really novel and like truly something that is specific to the crypto industry? And which of these activities are the kinds of things we already see in traditional financial markets?
Thank you. Thank you very much. And thank you, Santiago, for laying out the field. I hardly have to say anything now, except to say that really one can see how very diverse and layered it is, and how from a start in very much the financial world, and even in both licit and illicit, because crypto has a bit of a history, as many unregulated areas do, of being a platform for illicit activity. But there was very much financial based. And you can see from what Santiago has said, that it is now moving towards much more mainstream commercial in the field of property, in the field of art collection, in the field of pretty much every field of human activity. And so I think it's quite important to keep in mind that what we knew of crypto at the time of Bitcoin, 2008 or so, has now, which is over 10 years ago, has now evolved into something that is very much a feature of our daily lives. You have, for example, and I'm going to mention this very briefly, but you have decentralized arbitration, dispute resolution on the blockchain, for which you can buy tokens and have access to. So that's another area of human activity. What I wanted, so you asked me what is similar to what we know already. What is similar to what we know already is you have crypto trading, for example, which is very similar to the normal sort of trading platform that one sees commodities or other types of trading. I'm going to talk a little bit about a pending arbitration against Binance, the crypto trading platform, just to give you an illustration in a minute. But I wanted before that to focus on what I think is that crypto has enabled this area of activity to evolve, which I don't think existed before it, and it's the tokenization of human activity. So Santiago talked about different tokens, tokens of payment, tokens of assets. What tokenization means is that in a peer-to-peer environment, you can have individuals owning a fraction, so having fractionary ownership of a bigger investment. For example, you could have the tokenization of gold reserves. You could have the tokenization of real estate. You, instead of having to buy a huge bar of gold, you could buy the equivalent of a chip of the bar of gold, but without having to dismantle that bar of gold. You even have, and I'm sure you've read this in the paper, professional athletes tokenizing their employment contracts, for example, where essentially allowing the fans to purchase a token or part of their contract, benefiting from some of the return, and at the same time getting an engagement into the particular athlete's career. You have the tokenization of art, as Santiago mentioned. This is something that is becoming, I mean, you have, as always in crypto, complete hyperbole numbers mentioned, but it is, you can see right away that it is opening up avenues for investment that were not available before. That is a complete democratization of investment, and numbers that they mention into the $500 trillion. I don't know if it's that big, I have no way of telling, but it's going to be significant. Now, what does that mean in terms of ISDS and the investor to state paradigm is that all these investors will potentially, I mean, assuming, and we're going to talk about this later, there is coverage and there is protection, you can see straight away the rise of mass claims because you have all these people who are able to invest in a meaningful way, whether financial or not, but who have an investment into something that was before reserved to big players. And here I'm going to say a little word about the Binance dispute, just to give you a little bit of an idea what that means. And this is not an ISDS dispute; it's a commercial dispute, but it gives you a little bit of a sense what that could mean in the ISDS arena. So. Binance is a crypto trading platform, so you have individual traders who essentially trade in much the same way as you would in what we know about trading. As Santiago has mentioned quite rightly, it's an extremely volatile environment. Returns are far from guaranteed. Losses are more guaranteed than returns, in fact. And Binance has terms of use that make that extremely clear in block capitals, telling people this is not regulated, you have no protection, you trade at your own risk. On a particularly volatile day in November, I think last year, Binance shut down its platform so that for a couple of hours or a number of hours, so that investors were prevented from either withdrawing their money or closing their position or being able to get away from an investment that proved particularly risky. Losses were incurred from several million to a few $1,000s, and they have a funder, a litigation funder in this space called Liti Capital, which is out of Switzerland, I believe, has now funded a potential class action against Binance. And they are at the moment gathering interest amongst claimants. The terms of use of Binance contain at the moment an arbitration clause in favor of the Hong Kong International Arbitration Center. And so this is where they're going to file their arbitration. This obviously raises all sorts of legal issues that are completely novel. First of all, who do you sue? The platform doesn't have a legal entity in itself. The Binance corporations underpinning it are based in the Cayman Islands and elsewhere in Hong Kong as well. What is their relationship and liability to the platform? Who actually shut down the platform? Who took that decision? How do you ascribe responsibility? What law applies? All of these questions are completely up in the air, but that gives you a little bit of a flavor of the types of disputes that can arise in this space. I'm going to stop here.
That's great. Yeah, thank you, Sophie, for helping us sort of unpack and see where the potential could be for these claims. As you mentioned, that was a commercial dispute, and obviously we're talking about the implications for investment disputes. So this is maybe a good time for us to shift over to David and sort of talk about, or he can help us sort of understand whether we think bilateral investment treaties are going to be applicable to these new types of crypto assets. What are the types of legal and jurisdictional hurdles that could arise for these types of crypto investments?
Thank you, Kristen. So I'm going to focus my comments fairly narrowly on cryptocurrency as a digital asset, leave aside non-fungible tokens and the like. So as a general matter, although people are very familiar with bilateral investment treaties protecting things like mining investments and or energy investments, they're not really just limited to those sorts of physical assets. There have been a fairly significant number of disputes that have concerned loans, bonds, derivatives, and actually most of those cases have proceeded past the jurisdictional stage of the arbitration. So the tribunals haven't gotten so hung up on the fact that they were non-physical in nature. I do think that cryptocurrency presents somewhat different issues than we might have seen for loans, bonds, and derivatives. But before I get into exactly how those issues will work out, I just also want to note that many investments in the cryptocurrency industry don't necessarily raise particularly novel issues. So as Santiago mentioned before, there are huge investments in cryptocurrency mining, especially with regard to Bitcoin. And as Sophie just was discussing, there are cryptocurrency exchanges, which, may have their own complexities, but look something more like a traditional financial services business that may have one or multiple sort of physical or notional locations where they're carrying out their activities. So those don't really seem to raise a whole lot of new issues. But within cryptocurrency itself as an investment, I think there are maybe three major buckets of questions that we would want to address. The first is whether they qualify as investments under a bilateral investment treaty. The second, I think, more difficult question is where they're located for purposes of investment protection. And then finally, whether they qualify as investments under the ICSID convention in case an investor tries to seek protection in that particular form. So first, as a qualifying investment, I don't actually think that there are very significant problems here, at least under a range of more traditional investment treaties. As many of you already know, investment treaties will define the concept of a protected investment quite broadly. They will often define it as a non-exclusive list of particular asset types. And I'm just reading from, just to pull a fairly random example from the UK Morocco bit, which covers movable and immovable property. It also covers claims to money or any performance under a contract having a financial value. And I think according to this sort of, even these enumerated categories, it's quite plausible that many cryptocurrencies, stable coins, or even potential future CBDBs might qualify as protected investments. I think it's very plausible that a tribunal would find that they are movable property, or even though that they're non-physical, I think a reasonable construal of that category could potentially extend to them. And also, in the case that the investor doesn't actually hold their cryptocurrency directly, but is using some sort of wallet that's controlled by another party, there might also be a claim to money or performance involved. So it doesn't seem to me that there's such an issue under that part of the definition of a bilateral investment treaty in obtaining protection for at least certain cryptocurrencies. I think the more interesting issue actually comes up with whether they're located in a qualifying location for a treaty protection. Typical investment treaties, although not all of them, will say that that the investment has to be invested in the territory of a particular contracting party. But as Santiago was discussing, cryptocurrencies are in at least some sense sort of everywhere and nowhere. They exist in a series of digital ledgers stored on many different computers across the entire planet in some cases. So how are we to figure out where a cryptocurrency should be located for purposes of a bilateral investment treaty? Well, in the context of disputes over financial instruments like bonds, loans, and the like, a number of tribunals have adopted a test to determine the location of those sorts of investments, which are also have certain similarities in that they don't have an obvious physical location. I think the test that has been adopted pretty commonly by tribunals is first enunciated by the Abaclat versus Argentina tribunal regarding a bond dispute. And that tribunal said that with regard to investments of a purely financial nature, the relevant criteria should be where and or for the benefit of whom the funds are ultimately used and not the place where the funds were paid out or transferred. So how would that apply to cryptocurrencies? Well, let's use a concrete example. Let's take the case of Tether, which was also mentioned before as the predominant stablecoin. What if a government shuts down Tether? One of the largest cryptocurrencies, and which has collateralizes stablecoins in US dollars and several other major currencies. I mean, this example is not entirely hypothetical in nature. Tether has been subject to litigation by the New York Attorney General regarding certain accounting issues, and also recently had an investigation concluded by the US Commodities Futures Trading Commission regarding the supposed US dollar reserves it maintains to ensure the convertibility of its coins into actual US dollars. So let's suppose instead of just imposing a fine on Tether, the US government had shut it down completely. But so if the initial issuance of US dollar Tether coins took place in exchange for dollars sent to the United States, well, then the Abaclat test, which looks to where the funds were paid out or were transferred to and where the benefit was received, well, that would seem to point to the United States in that sort of case. But the reality of Tether is much more complicated. Like many other cryptocurrency businesses, Tether is structured through a series of foreign companies located in the British Virgin Islands, Hong Kong, and payments that Tether receives in exchange for its coins are actually routed through a series of foreign banks. And it's actually not entirely clear where those assets or those dollar transfers ultimately end up. So the interesting consequence of this is that sort of the locus of activity of Tether is not necessarily where the regulation is being taken place, assuming if we're assuming an example of a US regulatory action against Tether. The money could be going, to an account in the Virgin Islands or Hong Kong, but the United States is taking action against Tether, nevertheless, based on its transactions in US dollars. So I think it's actually hard to predict what a tribunal would do under these circumstances, because again, the Abaclat test would say that perhaps the cryptocurrency is not located in the United States, but nevertheless, the United States is actually taking regulatory action against Tether. I think one option, one possibility would be that the tribunal would adhere rigorously to the Abaquat test and determine that actually the cryptocurrency investment in Tether coins was not located in the United States, and therefore the tribunal has no jurisdiction over the dispute. But I'm not so sure a tribunal would go that way. I think at least some tribunals might try to expand the tests and find a way to locate the coins in the United States, because after all, that's where the regulatory action that's affecting them took place. But I think how this is going to play out in practice is very much an open question that will depend on seeing actual disputes. I'd also like to make a few comments about whether cryptocurrency would qualify as an ICSID investment. As is fairly well known, the ICSID convention requires an investment in order for there to be a qualifying dispute before ICSID. Unfortunately, the ICSID convention contains no definition of investment itself, but a number of different tribunals have identified a series of factors that are used to, at least in some cases, to determine whether there is a qualifying investment or not. These factors are often called the Cellini factors, after the Cellini case in which they were first, well, not first, but they were elaborated, and then that became the precedent that many other tribunals ended up citing to. According to the Cellini tribunal, an investment requires a contribution of money or assets, some risk, a minimum duration, and maybe a contribution to the economic development of the host state and some expectation of profit or return. So all of these factors have gotten a lot of development in assessing whether or not an investment exists. But for the purposes of cryptocurrency, I think the most interesting factors are those of risk and return. Tribunals to apply these factors to determine whether there's adequate risk associated with an investment and whether there's the right sort of return have not been of a single voice. Although many of these tribunals have construed the factors of risk and return quite liberally. But there is one notable exception to this. The Postava Banca versus Greece Tribunal, which was considering an investment in bonds, took the view that an investment specifically requires an operational risk, and that the profits or the return on the investment must depend on the success or failure of the economic venture concerned. I think it's worth considering how that reasoning would apply to Bitcoin, because it does bring out some interesting issues. Especially with regard to Bitcoin, there is active discussion as to the fundamental value for those of us who have followed the movements of Bitcoin over time. You can see these massive spikes and drops in value. I think over the course of the last year, the value of Bitcoin has gone from $30,000 per coin to $60,000 per coin, back down to about 30, and then back up to about 60. So it's quite the roller coaster ride. So it would seem that there's quite a bit of risk there. But there's also a question of why this currency is changing in value so rapidly. I mean, one view is that that Bitcoin is effectively a speculative bubble that inflates and deflates quite rapidly. And this is supported by the consideration that Bitcoin is really not associated with any cash flow. It's not like a stock or a bond where your ownership entitles you to certain income in the future. And so the view is that really the only value of Bitcoin is that somebody in the future might pay you more for it because they're in turn speculating on the future value of Bitcoin. Another view, though, is that Bitcoin might eventually become a regular medium of exchange, displacing the use of other currencies, dollars, euros, what have you. And if it does that, it will actually have intrinsic value because actual value will be locked up in that currency as a means of exchange. So going back to the Postava Tribunal's reasoning, if Bitcoin's a purely speculative asset, there may not be any operational risk because its value isn't really connected to the success or failure of any economic venture. And even if Bitcoin's value comes from its potential to become a medium of exchange, although this goes beyond how the Postava Tribunal is applying its concept, it might still not have an operational risk because there's still no specific economic venture involved. It's really just an investment in the potential for Bitcoin to displace other forms of currency and become what we actually use to buy and sell and make other sorts of transactions. So I think there is a view out there, a fairly well-known view, that might not qualify certain cryptocurrencies as investments. But I do think it's also very plausible that a tribunal that takes a more expansive view of risk and return may well find that there's adequate risk and return here, because after all, Bitcoin is a massively volatile investment. There's clearly a ton of risk in investing in it. There's no guarantee that long-term it will maintain its value. So I think some tribunals may look at those sorts of facts and find that Bitcoin would qualify as bearing adequate risk. Just one final remark. Stablecoins might face a somewhat different issue because by their nature, they're stabilized. Take Tether as an example, which we've talked about a couple times. Tether links the value of its coins to US dollars. So they should be relatively stable, subject to minor fluctuations, but relatively stable over time with regards to US dollars. I think there is a real question there as to whether that bears any risk at all. The whole point is to eliminate the risk, actually. It's to maintain a stable medium of exchange, and perhaps a tribunal might explore that particular issue in more depth to determine whether it would qualify as an investment under the ICSID Convention. But apologies for going so long. Let me turn it back over to Kristen so we can address some other aspects of how investment treaty protection apply to these sorts of assets.
Great. Thank you, David, for that, again, comprehensive overview, lots of topics to sort of unpack, and it's difficult to tackle this in the abstract. So I appreciate you kind of honing in on a couple of pieces of examples around stablecoins and to just give us a flavor of what the issues are going to be there. We have a question in the chat here that I want to bring into the panel about someone raises, what characteristics distinguish cryptocurrencies from traditional currencies for the purposes of an investment analysis? And this could go to any of our panelists. I mean, we're talking here about the nature and the characteristic of these assets. Wondering if anybody has thoughts on that.
Go ahead, David. Go.
No, go ahead, Sophie, please.
I was just going to say, and certainly please feel free to chime in as well. I think as we've discussed up to now, the fact that they are decentralized, the fact that they are not held in one place, the fact that they are very much subject to, I mean, if we talk about Bitcoin, not CBDC, which has not been adopted just yet, but is subject to market volatility. There are characteristics there that, for the moment anyway, I mean, it may well be, as we've discussed, that in due course and with better acceptability, they might converge. But at the moment, certainly, you cannot have, unless in a place like El Salvador, for example, that has adopted it as a formal currency. You cannot have government action, unilaterally, essentially shutting down or devaluing it. It's a completely different environment. David, please.
Or Tom, I see Anna Fernanda, you've got your hand up.
David had something. I would add, one important distinguishing factor between traditional currencies and cryptocurrencies is the regulatory uncertainty. We don't even necessarily know what to call cryptocurrency. We call it currency, though some of our regulators will call it a security. Some call it a commodity. And so that lends different regulatory risk. And given that it's relatively new product, you don't really know how it's going to be treated. And we see governments experimenting, as they do with all new technologies, with how to adequately regulate it. And so there's a lot of question marks around it that you don't necessarily have around traditional currency.
Yeah, great. Ana Fernanda, you see you have your hand up.
Yes, actually, I'm a bit of the stranger here because I'm a former central banker. Conceptually, I would actually challenge that they are currencies. They are accepted as means of payment, but so could be a cow or gold or I don't know. Well, I wouldn't want a cow, but conceptually somewhat could. And in that sense, they are accepted, and they're going to be a very large part of the modern discussion, as I think you all agreed on that. But the idea of a currency, on the one hand, has a social value. There's a social country, and that's why it has intrinsic value. It doesn't actually. I mean, a bill has power just because institutionally we all decided that it actually has power. And to give that bill that power, the physical bill that power, there are certain things that we usually check to see if it actually works. And it's not only that it can be accepted as a means of payment, but it's also the fact that it can contribute as a storage of value and as a unit of value. But as I don't remember who of you or maybe all of you mentioned, since the supply of cryptos is not centralized precisely, you cannot actually guarantee its stability, which is different for stablecoins. And since therefore there's not a central regulator because you don't have a central bank behind it, you cannot control supply and demand as you would usually do with a fiat currency in order to make it stable. And therefore it's very difficult for it to be used as storage of value, and definitely very hard for it to be a unit of value, because as David was saying, you could go up and down within hours even, and that makes it very difficult for it to be a currency. It is definitely an asset. And I think that when they or somebody came up with the idea of cryptocurrency, all our mindsets went to, oh, this is a different kind of currency. But I would actually challenge the idea that it's actually a currency. It's an asset. It's a very particular and new asset that doesn't really fit in what we have in the social contract implied in currencies. So I would actually say that they're not only very different, they're actually different things at the end of it.
Yeah, go ahead, David. Do you have a reaction? Thank you for that.
You just wanted to add to the prior comments just one observation, which is that it's not only cryptocurrency or non-currency that we have this issue of whether they're investment. To the best of my knowledge, regular fiat currency has never been the direct subject of an investor-state arbitration. There have been a number of disputes related to bank deposits and other things of that sort, but it tends to not be directly targeting the currency itself.
If I
go ahead, Santiago.
Just may add one thing, just on top of what David just said, and I would just like to go back a little to the start of my presentation. That again, the term cryptocurrency is used as a broad term to include many different digital assets, and at the end, if we are just thinking about Bitcoin, we're going to miss the big picture when we're talking about ISDS, because as David is just saying, I don't know of any dispute in ISDS that involves the dollar as an investment, the dollar per se. And so that could be transferred, the same idea could be transferred to payment tokens, as I was saying, like, for example, Bitcoin. However, we have, as Thomas was saying before, there's regulatory uncertainty because certain digital assets are conceptually very similar to already regulated assets like securities. And so, for example, an asset-backed token, is deemed by many regulators as a security. And so the same regulations and the same issues and the same controversies as with regular securities can apply to these types of tokens. And so when we're talking about ISDS, I think it's really important to have in mind always that we're not necessarily talking about Bitcoin or maybe Ethereum, but it could also be other types of tokens that can be subject to ISDS.
Thank you. Yeah. David, do you have anything to add there?
Nope, not at this point.
Okay, sorry, I just saw you take your mic off. Okay, great. Yeah, no, I think that's this is maybe a great point for us to sort of transition into where we might see potential investment claims coming up. I mean, I think this was a really great starting point in terms of like thinking of all the various pieces of whether and how crypto assets in their various forms might be covered investments. I mean, certainly, as David said, this issue of this real transnational nature of these assets, and as is going to raise questions about location. And Sophie gave us a flavor of that, with the Binance dispute as well. But I think I want to move the discussion on to whether, the treaties provide any sort of meaningful substantive protection for crypto investors. So maybe Sophie, I'll go to you and ask, we sort of touched on, Tom raised this issue of being a really highly unregulated environment. And Santiago raised at the beginning, this is sort of a high risk, high reward, volatile space. I mean, do you think that investors should just assume that bilateral investment treaties won't provide them any meaningful protection? Maybe that's a philosophical or a bit of a provocative way to ask it, but
right up my street. Thank you. So as we've discussed, it's important to, as I think Santiago's pointed out quite pithily, actually, that there are the crypto assets or currencies or non-currencies, I'm not sure what to call them now, but there is also the investments around them. So investment protection in the classical sense is very territory bound, is very sovereignty bound within the four corners of a state. And the challenge that we now have is with crypto is that it breaks down those barriers completely. And so whereas one can probably see the protection against expropriation applying to mining farms, for example, which are brick and mortar activity, it is much less readily seeable or visible what sort of protection, fair and equitable treatment, protection from police powers, the transfer of returns and profits from the investment in and out of the jurisdiction. This has very little sense in the sort of monetary sense of the cryptocurrency. And at the same time as well, the fact that these exchanges, even though the mining farm has to be located somewhere, what comes out of it, the power of it and the network, it completely breaks down boundaries. It exists in the digital world. And although one could probably stretch the concept, and heaven knows tribunals have been good at that, stretching the conceptual side of the investment protection to cover them. I think for some of these activities, one would be thin on the ground. The very important point raised by Tom of the lack of regulation. I mean, there are countries that have now put a ban on crypto transactions. India is one, for example. I believe China is another. For those countries, it's quite clear that those investments would not fall under the legal system of the state, and so therefore no protection can be expected. For those countries where there is some protection of some aspects, which I understand from what Santiago, I think, said is the case in the United States and perhaps elsewhere, where you are starting to see pockets of regulation, or somewhere it's just completely a big gray space, then you have a big question mark as to whether a state would have intended to protect investments such as this, where there is, because in much of the, if not all of the investment treaty jurisprudence disputes that we have, we are not talking about unregulated spaces. We are talking about activities that are regulated. And so therefore, the question, is it legal, is it illegal, was a question with an answer. In the crypto space, that answer is much more diffuse. So that's where I would say to investors, do not assume no protection, but assume that you are going into completely uncharted territory and that those treaties have not been drafted with this type of digital world in mind at all.
Yeah, that's great. Great insights. Tom, do you want to build on that and just give us a sense of kind of what types of state actions could potentially trigger claims under a treaty? I mean, I see a question here in the chat as well that gets at this point, how can, if this is, crypto assets are decentralized, how can states really be held responsible? What's the level of state responsibility under ISDS here? Aren't states equal with other crypto actors? So,
Sure. Thank you. First, I should say thank you, Kristen, and thank you to Jose Antonio for putting together this excellent panel. I'm enjoying it very thoroughly so far. These are great questions, and I think referencing back to David's 3 buckets, we're really talking about the territoriality bucket, right? Are these investments within the borders of the state, as Sophie was saying? And I think you really need to look at how investors are using cryptocurrency in its various forms to kind of get a sense for whether or not they would be protected. And I think there are many instances where they would be. And we like to talk about currencies, these digital currencies is kind of floating in the air and in the cloud. But in many cases, I think the investments around them are much more traditional in nature. And so, for example, across numerous industries, companies are investing heavily in the ability to transact in various digital coins to both receive and make payments. And that's true in almost any consumer-facing industry, telecoms, retail, banks, you name it. They're investing in this ability to transact. And that means they are exposed to regulations that prohibit them someday from transacting or treat cryptocurrency in a way in which they did not foresee it being treated. And there are heavy investments in that area. And if they were to suffer losses as a result, would they be investors? I would think most likely, because we're talking about actual entities with presences in host countries where they would have had their operations affected because of new regulations on a way in which they had started to do business. The mining of cryptocurrency is an example that a lot of people like to come back to because it feels like manufacturing. It feels very traditional in the sense that you have a facility somewhere, you invested in infrastructure, you have employees, you have contracts, and as a result, that feels like a traditional investment. And we were talking before the panel started about the fact that there are certain countries that are actually even giving incentives to develop those types of facilities within their borders. And there's kind of the risk that we see what has happened in the solar space with incentives being given and then withdrawn. You could see that happening potentially with regard to mining operations. Similarly, there are the exchanges. Certainly, if an exchange is based in a country, you could and regulated by that country, you could see that as an investment. Then there's the question of whether if they're doing business in the country. And if they're doing business in the country and they have contracts with clients in the country, they may have protected IP in the country, trademarks, for example. That again feels like a more traditional investment. They might be dealing in cryptocurrency, but it feels like a traditional investment. And I'm actually kind of fascinated by the idea of initial coin offerings. If you acquire coin from an entity in a country, that are you effectively a shareholder in that entity that just issued an ICO? I don't know the answer to that, but I can certainly see an argument that you are now holding securities. And I think some of our friends at various regulators would share that view as well. And so there are a variety of scenarios where foreign investors could be dealing in cryptocurrency and likely be protected. The harder question is, if you are just holding cryptocurrency in a digital wallet in a certain jurisdiction, is that somehow a protected investment? And that's a more complex question. Though I think there are a lot of money in the other scenarios that we talked about, a lot of foreign investment being done in the other scenarios that we discussed. I'll pause there.
Great. Certainly a range of potential for claims. I want to draw you out a little bit on this idea of mining. We have a question in the chat that says, have any of the panelists come across disputes relating to the environmental impact of Bitcoin and other crypto mining? So as you raised, Tom, crypto mining is a really energy intensive space. And we've seen a number of countries like Kazakhstan, for example, invest in incentives to woo crypto investors, but then have to pull back because of energy crisis and things that have emerged. Do you see this sort of crypto mining activity coming up against environmental regulations or concerns?
It certainly sounds plausible. I'm not aware of an example, and I would imagine it would be treated in a manner similar to any other industry that has environmental concerns, but it certainly sounds plausible. I mean, I think the issue tech, and I'll include crypto in that, runs into is that it does things very well that no one has ever done before. And in doing so, it disrupts industries, and it does it in a high profile way, which means it is exposed to a lot of scrutiny and a lot of regulators who are trying to regulate something that's never been regulated. And so there will be some success, and there will be some errors in these regulations, and some of that will lead to investment claims.
That's a great point. I mean, we're definitely in a new regulatory space. And I think on that note, I want to turn to Ana Fernanda and get your views, on some of the complexities here around thinking about how to regulate these new crypto assets. Should states be, prohibiting the creation of these crypto assets or regulating them in some way? What are your thoughts on this, Ana Fernanda?
Yeah, thank you, Kristen. Well, I think that to the point of prohibiting, I can gather what all of the panelists have said in terms of the complexities of prohibiting where and therefore prohibiting how. And how can you prohibit something to your national or to your resident if actually that activity occurs within their computer, etc. So that's a very difficult road to follow. We have examples of the idea of prohibition, but I wouldn't think that it would be easy for most states to go that avenue and think that there is a credible enforcement to that prohibition. So then you get to the space of regulation. And the main idea there is, why would you regulate? And I think it comes to the core of what we have all been discussing. Well, there should be some protection. Well, but protection about what? If you want to go into these assets, you have to be willing to admit that you're going into an extremely high profile, I like how Tom put it, combination of risk and return. And then you cannot, if you are protected from that risk, then you could not be holding the returns. So therefore, in that particular space, you shouldn't be talking about any protection really. You could be talking about some other protections, and we have clearly heard about the complexities of that. And then you come to a certain points in which there could be a regulatory space. What happens with money laundering and asset laundering? For some states, that's a very critical point in which you could have a regulatory discussion. Colombia is one very easy example of that, because for our the drug dealing activities of some part of our agents, the pure money laundering issue is very important in our regulatory space, in particular for the financial system. And then that's something that is mostly concentrated in the exchange. And the exchange, as we have already heard, the exchange is an agent that has residency, that has jurisdiction, that you can actually physically find. And therefore you could regulate the exchange, but it's important to see that you're regulating the exchange. You're not regulating cryptos. As in many cases, you're regulating probably the platforms in which some trade activity may occur, but that doesn't really mean that you're regulating the underlying asset. However, this is a very, ongoing discussion, let's say. I've heard in many places, again, I think because the first bias that was introduced was in calling them cryptocurrencies. And I heard Santiago, when we talk about cryptocurrencies, nowadays, you never know what are they talking about, because they could be talking about stable coins, Bitcoins only, or central bank digital currencies, which don't have a lot to do really with crypto assets. They're a very different thing, starting because they have a central bank behind it, and because digital currency by central banks have existed long ago. It just become very fashionable now, but the idea of it's an old one. So when you come into why should we regulate, many say, well, this is financial in its nature. But I think that again, it's a challengeable idea. And if one thing is that you decide to regulate the exchange, but some other is that you decide to regulate the asset. And I think that we have this sort of urge to regulate without asking first the proper questions is, why would we regulate? One. And two, does any of the outfits that we have created as regulators fit this new asset? And they don't. And I think as Sophie was mentioning a while ago, these treaties and these protections that we have built were not built with this kind of framework in mind. And therefore, what I actually think that would be the most profitable avenue of work is that we think about the usual questions that we have probably not asked ourselves in a while. We have to ask them again. Why would we regulate? What kind of protection makes sense? Is there some sort of consumer protection that makes sense? And maybe there is, but it's complicated because it's complicated to enforce. Because again, this transnationality, it makes it very hard for it to happen. And therefore, I think that we will keep on seeing a discussion. But I think that the idea of the financial mindset that we all got in because they were initially called cryptocurrencies distracted us, because it took all our minds to say, oh, this is financial. So we should do what we do with financial things. But the thing is that financial things occur in a highly regulated environment with a very large protection of the state. And to try to incorporate these assets into that framework means that as a state, you would be responsible for things that you cannot control in this environment. They're absolutely not the same kind of things that we talked about when we talked about financial regulation and financial activity. So again, this is only my personal view, but I think that it would be important if we should go back to square one in terms of the questions of why do we regulate? Because otherwise you may up ending with huge responsibilities for the states that they cannot or that they should not respond for, because they are actually not able to control the sort of things that happen in this crypto environment, because it's very different from what we knew. And it's very useful. And I think I hope that they keep on flourishing and doing things. But regulation is not necessarily, you don't have to regulate everything. And in this case in particular, I think that it is critical that we sort of separate with the idea that what they were originally baptized as currencies.
Great. Yeah, so many things to dig into there. Ana Fernanda, thank you for those thoughts. I just want to go quickly to Santiago because I think we'd be remiss if we did not talk about El Salvador and Venezuela and where you see the risks around some states shifting towards cryptocurrency as an official or alternative currency or recognizing it as legal tender. I just want to hear your thoughts in terms of potential for investment claims there.
Thank you, Kristen. So I think that adopting cryptocurrencies or central bank digital currencies separately as legal tender in a country can open states up to existing risks and new risks that are inherent to these technologies. And so, for example, as you mentioned, El Salvador adopted Bitcoin as legal tender. And so, as Thomas was mentioning before, just holding Bitcoin doesn't necessarily constitute a protected investment if it's considered legal tender. However, what you do with Bitcoin, for example, mining Bitcoin can be if it's done in a large enough measure. If it's, for example, as we were saying before, if it's done in a warehouse and you invest in thousands of computers and it constitutes an investment under, for example, the Salini test, as David was saying, that can constitute a protected investment potentially under ISDS. So just holding Bitcoin, if it's considered legal tender by a country, doesn't necessarily elevate itself to a protected investment. However, I do want to add something in this point regarding mining that I do think might be a novel issue for ISDS. So, for example, in Spain, the previous government around 2007 created several incentives for renewable energy projects to be developed in Spain. Then the next government repealed those incentives because they were financially unviable for the government. And so a bunch of investor-state disputes were started, and different tribunals all considered that there was a protected investment because a renewable energy project meets the criteria under public international law. However, if we consider, let's use the example of mining. And so let's say that X foreign company invests in El Salvador because El Salvador is offering financial incentives and subsidies for foreign actors to invest in mining in the country using geothermal energy. This is all true. Let's say that a foreign investor does a sufficiently large investment in mining in El Salvador to meet the criteria that the checklist to constitute an investment under the Salini test, for example. However, there's a difference here between renewable energy projects and mining, and as someone was asking in the chat, and it's related to climate change. And so arbitral tribunals will be faced with the question of answering whether mining is a protected investment if it's, because one of the things that needs to be answered in the Salini test, if the investment is contributing something to the economy, if it's positive for the economy, essentially. And so is something that can be considered dangerous for climate change, if it's considered toxic for climate change, is it something that is contributing to the economy? And so here, I think there's a little twist with regards to mining. And the other example that I wanted to give was regarding central bank digital currencies. And so, for example, Venezuela made a failed attempt of central bank digital currency. As I was saying before, it pegged it to a basket of minerals and of oil from the country's oil reserves in a very ambiguous way that was not clear. However, the question that may arise in the near future with regards to central bank digital currencies of these characteristics, again, that are pegged to certain physical assets, is whether they are actually a security or whether they are a bond, despite having a country call it a legal tender. And so Venezuela can say, this is my legal tender, this is money, this cannot be a protected investment, but a foreign actor who holds X amount of CBDCs that they can't trade outside of Venezuela or X country, and that CBDC is equal to X amount of gold money in gold reserves of the country, that can constitute for a foreign tribunal that may constitute a foreign investment because it's measurable in an asset that that is a protected investment for public international law purposes. And so I give it back to you, Kristen.
Great, thank you. I mean, so many ideas to discuss here, and I would love to sort of welcome more thoughts about this idea of adopting cryptocurrencies and whether states should or shouldn't, and what are the risks around that, because there's so many interesting things to unpack. But I'm seeing that we're pretty much at time here. So I will just open it up really quickly to the panelists if there are last final reactions, and then I welcome everyone to stay, because I think we're going to break out into breakout rooms briefly for a bit of informal chat and networking. So first, any last reactions or comments from the panel?
I have one, Kristen. And
sure.
I hope you don't mind me making it. If anyone in the audience is looking to get up the curve on the issues we've been talking about, Kristen has a very good journal article that she co-authored that she should put into the chat for folks. I think it's a good step forward. Other than that, great panel. Thank you.
Thank you. Thank you for those kind words. Yes, happy to share that in the chat with folks. Okay, well, with that, then we'll just really truly thank this wonderful panel for lending your extremely diverse, broad range of expertise that is required to tackle these issues. I mean, I think that it's safe to say we raise more questions than answers, but this is only the beginning of the conversation, and it was just a delight. I would like to just stay and chat with all of you for very much longer, but thank you so much for sharing your ideas on this very forward-looking panel and helping us sort of speculate about where the potential issues are for crypto and investment claims in the future. So thank you all so much for your participation.
Thank you, Kristen.
Thank you, Kristen.
And thanks, everybody. Super interesting.
Thank you.
Thank you so much. Okay.
Jose Antonio?
Yes, I'm here.
Okay.
For a second, I thought that I was cut off, but no. Well, thank you so much, Kristen and Santi. I'm reading. I'm spelling your names as I see you in my camera. So thank you so much, Santiago and Tom and David and Sophie and Ana Fernanda. It was and thank you, Tom, for raising the issue of Kristen's article, for which she won a prize. So you know, more kudos to her. In any event, I'd like to really thank you, because this was a wow panel. I think that I certainly learned a lot. It gave me much food for thought in terms of investor-state arbitration, and also it taught me quite a bit about cryptocurrency. And I hope that everyone enjoyed it, and it you know, brought me back to the rationale of why regulations should or should not exist, and central bank and monetary policy responsibilities. So this was a tremendous panel, and now we're going to move into the breakout rooms. And on that, what I would ask to each one of the participants, you included, is that you should be receiving in a few seconds an invitation to go to a breakout room. If you do not accept, you will not go to the breakout room. So I ask that you do accept the invitation to go to a breakout room. Otherwise, we'll be stuck in the main room. So with that, really fantastic job, Kristen, and we made it happen. That's wonderful. Enjoy your breakout session, and truly we should get together later and have some coffee, you know, virtually at some stage during the breakout room. So enjoy your time with other folks. Thank you.